In a world of financial turmoil and growing global uncertainty, experts are sounding the alarm bells about an impending economic crisis. Join us as we delve into the reasons behind a potentially catastrophic 50% market downturn that's looming on the horizon and discover what it means for investors everywhere. Stay ahead of the curve and equip yourself with the knowledge to protect your assets in these challenging times, with insights and analysis from some of today's foremost economic thinkers. Please support our channel with a thumbs up and don't forget to subscribe to our channel. The swift escalation of mortgage rates and the ongoing deceleration in the housing market has led some to anticipate a potential economic downturn in the last month. Elon Musk, the founder of Tesla and proprietor of Twitter, a multi-billionaire, shared his estimation that commercial real estate is swiftly deteriorating and home prices are next on the chopping block. This line of thinking is shared by officials at the National Association of Realtors. They projected a significant decrease in median home prices by 18% in the near future. These projections are based on a wealth of data and analysis that point to a troubled housing market that is likely to face hardship in the coming months. The current state of the American housing market is worsening, leading to significant concerns amongst industry professionals. The decline began in the summer of 2022, and recent events have only served to trigger it further. This has resulted in a pronounced slump in home prices, and as a result, mortgage companies have begun resorting to mass layoffs. There is a growing warning from real estate economists that a housing recession is looming on the horizon. The National Association of Realtors has voiced concerns that home prices remain significantly overvalued and that homeowners in certain markets may see the value of their properties drop by up to 50% before the year's end. Experts have estimated that this could potentially result in a six-figure loss in home equity over a single year, which is a significant concern for homeowners across the country. The current conditions of the housing market are now eerily similar to those which led to the 2008 financial crisis, and industry professionals are anxious to see how the situation will develop in the near future. The current economic situation in America is characterized by a sharp increase in interest rates, leading to a significant risk of a major economic downturn and housing market collapse. This rise in interest rates has led to an almost 7.4% surge in mortgage rates and a corresponding increase in the 10-year Treasury yield to almost 4.3%. These astronomical levels are having a debilitating impact on economic activity and causing a severe contraction in demand for housing purchases. This economic dip is also evident in a record decline in mortgage applications for home purchases, with numbers reaching their lowest point since 1995. Over the upcoming summer and fall seasons, sellers in the U.S. housing market will have to be prepared to significantly reduce their prices to attract buyers back into the market. This prediction is based on the current rates at which property is being sold, with several houses remaining unsold on the market for a period of 30 to 60 days in certain metropolitan areas like Texas, indicating a decline in buyer activity. The expected price cuts during the upcoming summer and fall seasons are projected to be far greater than those witnessed in 2022. It is expected that a number of individuals and households will exhaust their financial resources, leading to a situation of financial strain. Recent data indicates that the personal savings rate in the United States now hovers around 4.3%, which is the lowest level recorded to date. This is in stark contrast to the historical average savings rates of 9 or 10%. A savings rate of 4% is indicative of a broader trend, suggesting that a significant portion of the population is experiencing financial hardship and is unable to accumulate any savings. In a recent interview with Insider, the chief economist of NAR, Lawrence Young, shared his predictions for the real estate market in the coming years. His insights indicate a potentially significant decline in home prices, specifically in overvalued markets, which he predicts will experience a 50% decrease. This trend is expected to be most pronounced in metropolitan areas across the western United States, where 0% growth in home prices is expected for 2023. Young observes that the most severe price declines are likely to occur in the most expensive regions of the country, including popular pandemic boomtowns such as Phoenix and Seattle, as well as cities situated primarily on the West Coast, such as San Jose and San Francisco. Given these patterns, prospective buyers, sellers, and investors in the real estate market should be aware of the risks and opportunities that lie ahead. The present economic landscape is characterized by true corrections in the pricing of various assets. In particular, discerning financial institutions caution that losses may escalate twice as much due to an array of economic challenges. For example, consider Goldman Sachs, whose analysts believe that some very hot real estate markets on the Pacific Coast and in the Southwest, like the San Jose Metropolitan Statistical Area, Austin MSA, Phoenix MSA, and San Diego MSA, could see further declines exceeding 25%. This reality potentially exposes particular localized risks for defaulting on mortgages that originated during late 2021 or 2022. Nevertheless, economists remain fixated on the question of affordability, which they see as a major concern. To this end, further scrutiny and forward thinking on the strategies to cushion against economic headwinds is warranted. The National Association of Realtors has released a report that presents the bleak and disconcerting reality of the United States housing market. The figures from June revealed a sharp decline in home sales for the third consecutive month, with a staggering seasonally adjusted annualized basis drop of more than 20%. The sales slumped by 21.7% in April and May, with a percentage decrease of 23 and 20.4 respectively. The evident reduction in transactions is noticeable in all classifications of homes, including single-family homes, townhouses, condominiums, and cooperatives. The aftermath of the current crisis is significantly impacting the housing market, with 37 of the largest 50 markets in the country registering a double-digit drop in prices already. In certain markets, homes are witnessing a hefty price tumbling of up to 25% from their documented peak in 2022. The situation is alarming, and intervention is crucial to revive the housing market's well-being. Jeff Green is a prominent investor who has amassed a considerable fortune during the time of the financial crisis in 2008. Green's insight into the real estate market has led him to caution against potential destruction across the entire industry. In line with Green's concerns, the chief economist for LPL Financial in Charlotte, North Carolina, has released a statement which suggests that the current economic outlook appears ominously similar to the prelude of the infamous 2007 housing market crash. During this specific period, the Federal Reserve chose to adopt a policy of raising interest rates, while also holding the belief that the housing market was becoming more stable and the economy would continue to experience consistent growth, with no major concerns about inflation. As history has shown, these predictions did not pan out as expected, and the subsequent quarters bore witness to unexpected financial collapse. The present environment bears an uncanny resemblance to the aforementioned 2007 crisis period, and investors should therefore remain vigilant and anticipate heightened volatility during this cloudy economic outlook. Dave Burt, the CEO of Delta Terra Capital, a respected investment research firm with expertise in risk management, has cautioned that the present financial circumstances bear a striking resemblance to the conditions leading up to the 2008 global financial crisis. Burt, who is renowned for his prescience in recognizing the impending collapse of the housing market back in 2007, aided two investors, as mentioned in Michael Lewis's renowned book, The Big Short, in betting against the mortgage market, which eventually earned them millions after the bubble burst in 2008. Regrettably, Burt believes that there are a few overlooked risks that could trigger another financial catastrophe similar in scale to the 2008 crisis. Speaking to CNBC, Burt expressed his concern over the impact of economic and societal instability that often accompanies financial downturns, which he has witnessed firsthand. He cautioned that the ongoing market correction will undoubtedly have severe repercussions, particularly in vulnerable communities, and voiced concerns over the prospect of a housing market crash that is rampant among investors. Experts have identified clear signals that indicate an imminent housing crash. The first key indicator of this event is the continuous surge in unemployment rates, which has been particularly evident in several industries. The year 2023 saw major corporations, tech firms, and retailers announcing massive layoffs, further exacerbating the situation. Recently, there has been a gradual increase in the unemployment rate, which currently stands at approximately 4% according to U.S. Bureau of Labor Statistics. Historical data also shows that before the onset of the Great Recession, joblessness peaked at 4.4% in October 2006. In the event that the unemployment figures consistently escalate from this point onward, an eventual market crash may arise, particularly in the housing industry. As a result, the discontinuation of remote work arrangements has raised concerns among experts about the potential for an impending housing market collapse. In recent months, numerous businesses have taken a U-turn on their flexible working policies, prompting certain employees to sell their homes and seek accommodation in less urban and more affordable areas such as Boise, Idaho. Experts predict that this trend could render Boise the epicenter of a grim 50% plummet in the real estate market. In this troubled scenario, employees find themselves in a precarious situation, struggling to choose between protesting against the end of remote work policies and risking losing their jobs or complying with their employer's demands. This new reality, coupled with the looming threat of a profound recession, is causing widespread anxiety about the potential for a catastrophic decline in the housing market. In conclusion, not only will current homeowners be affected by the economic crisis, but future buyers in the housing market will also feel the effects of reduced demand and higher mortgage rates. As such, it is essential for consumers to stay informed about the current state of affairs and remain prepared for a potential downturn. This includes carefully researching different housing options available and working with experienced lenders to get the best mortgage terms possible. With proper preparation and a keen eye on the market, home buyers can position themselves to make sound investments despite an uncertain time. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.